Hello and welcome back to Brigham Young University, Hawaii, Economics course online. Today we're going to talk a little bit more about taxation and the government. In our last section we talked about what the government does to intervene in the markets. Today we're going to talk about how the government finances itself. We're going to talk about paying for the public sector, systems of taxation, in general the most important federal taxes, tax rates and tax revenues, and then taxation from the point of view of producers and consumers. And finally, we're going to leave financing Social Security to you. Allow you to look up online some ideas about how Social Security finances itself, as well as if you have access to the textbook for the course, the section in there on Social Security. In general, the government has three ways to finance itself. Remember, the government doesn't make money. The government can only take money from those who earn it. And it does this in three ways. One is through fees and user charges. If you were to use a national park and you're charged $10 of an entrance fee, that would be one of these fees or user charges. Second is through taxes, the ability to levy taxes on the consumers and citizens in their jurisdictions. And the last one, if after the fees and after the taxes they still don't have enough money to do what they want to do, they borrow. Over the last 30 years, we've borrowed a lot, and the U.S. government is significantly in debt because it chooses to spend money that is far in excess of the fees and user charges it collects and the taxes that it charges. You would think that the government would operate under what is called a budget constraint. It seems reasonable because most households have a budget constraint that is largely determined based upon how much income they earn. But the government doesn't necessarily do that. The government believes and has operated under the premise that whatever it doesn't collect, it can borrow. And up to now, that's been a pretty good assumption. Over the next 10 to 15 years, we'll probably test that assumption significantly. But this government budget constraint is the limit on government spending and transfer payments that a government can incur. It is imposed by the fact that every dollar spent must be provided for by taxes eventually, sometimes after the borrowing has occurred. Systems of taxation are very interesting. Let's assume that we have a community of 50 people, and we're going to impose an income tax on those 50 people. Those 50 people constitute the tax base for the income tax. The tax base can be a value of goods, services, wealth, or incomes that are subject to taxation. Then there's the tax rate. Of our 50 people, let's assume that we have a tax rate that is the proportion of the tax base that must be paid to a government in taxes. So if we have our 50 people and they are earning incomes and we're going to impose an income tax, the rate will be the percentage of the income that we are going to impute in taxes. In general, the most efficient tax that can be created is one that has a very wide base and a very low rate. Wide base and low rates are the most efficient taxes. Now this section goes through a lot of definitions. Remember, anything that's red and bolded needs to be able to be defined and be able to be used. We're going to talk about tax rates in this section, and so you're going to have to be able to calculate individual tax rates. So get your calculators out and make sure that as we walk through these things, you can get the right answers. We're going to start with the marginal tax rate. It's the change in the tax payment divided by the change in income. So let's just assume that we paid $20 in taxes last year. And this year we're going to pay $30. So the change in the taxes due is the difference. It's the $10. The change in the taxable income, say we went from $50,000 to $60,000, would be $10,000. So the marginal tax rate is just calculated by the change in the taxes due over the change in taxable income. This is a very important principle, and this idea of marginal is a very important principle to understand for the rest of the course. In general, marginal tax rate just means what is the tax rate on the last dollars earned. Okay, so think about that. The marginal tax rate is the tax rate on the last dollars earned, not the tax rate on all the dollars earned. That would be average tax rate. The marginal tax rate is just the tax on the last dollars earned. Let's talk about tax bracket. This is a fairly specified interval of income to which a specific and unique marginal tax rate is applied. You probably often hear your parents talk about what tax bracket they're in. What they are implying is that there's a percentage in taxes that they need to pay for the last dollar that they earn, and that's their tax bracket. The average tax rate is just the total tax paid divided by the total income. And remember, the marginal tax rate is the tax rate that is paid on the last dollars earned. Proportional taxes. This is a tax system in which, regardless of an individual's income, the tax bill comprises exactly the same proportion. You know this as tithing. Tithing is similar to a proportional tax because if you earn $10,000 or if you earn $100,000, you still pay 10%. That's an example of a proportional tax. Proportional taxes are fairly easy to calculate. Here you have a situation where you've earned $10,000. You have a tax rate of 20%. Your taxable liability is $2,000. It's the same tax rate here if you earned $100,000. So at $100,000, you're still paying 20%, but your tax liability is larger. But this is still a proportional tax because the rate is the same. So when the rate is the same, your marginal tax rate here, which is the tax on the last dollar earned, is the same as your average tax rate. That's the example of a proportional tax. A lot of people right now are lobbying to change the U.S. tax system so that it is not progressive, which we'll talk about in the future, but is proportional, which means all of us would pay the exact same rate, although we'll have different incomes, we'll pay that same rate on all the income that we earn. Progressive taxes are different. Remember, proportional tax rates, we use the same rate on all the income that we earn. A progressive tax system says it's a system where as income increases, a higher percentage of the additional income is paid in taxes. So in this situation, as we earn more money, the rate that we pay increases. So as an example, let's consider this. Now here you have tax brackets. So from $0 to $10,000 in income, you're going to be charged 5% in taxes, which means you'll pay $500. Now for the next bracket of income, so from $10,000 to $20,000, you're going to pay 10% on that $10,000 worth of income, which means you're going to pay $1,000 in income taxes. Now on this next bracket of income, from $20,000 to $30,000, you're going to pay 30%. Now that's still a $10,000 chunk, but you're going to pay 30% on that chunk. And so your tax liability there is $3,000. What's interesting is your total tax liability is just the sum of each one of those individual liabilities, which equals $4,500. This is how you would calculate taxes under a progressive system. This is the income taxes, both corporate and personal, in the United States are based upon a progressive tax system. The theory being that as people get wealthier and wealthier, they should pay an increasing proportion of their income in taxes. Now this top tax bracket has come down significantly over the last 30 years, but under the new administration's tax proposals, it's going to be going back up significantly. Regressive taxes. The opposite of progressive taxes, but it's a tax system in which as more dollars are earned, the percentage of tax paid on them falls. So in a progressive tax system, we have a $50,000 of income and we have a rate of 10%, so you have a total liability of $5,000. Now, under this regressive system, you have $100,000 in income, so much higher income, double the income, but the rate has gone from 10% to 5%, reducing your tax liability as a proportion of your income. So this is a regressive tax system. Let's talk about the most important systems or applications of taxes in the federal system. Question is, what types of federal, state, and local governments collect which types of taxes? Answer, federal government, the largest proportion of their income or their taxes, tax revenues, come from individual income taxes. Then corporate income taxes and Social Security taxes, import and excise taxes. But by far, the largest is individual income taxes. That's not the case for state and local governments. State and local governments get most of their taxes from sales taxes, property taxes. Personal and corporate income taxes are by far smaller. If you were to look at a graph, some pie charts that show this, you see the tax receipts here are individual income taxes, almost 50% of total federal tax receipts. Then you have over here Social Security taxes, and here's the corporate income taxes. They're fairly lopsided. You have a significant part of your tax revenues coming from individual income taxes. Over here in the state and local pie chart, you see that things are pretty well spread out. And in general, you get a lot from sales taxes and you get a lot from property taxes, and much less as a proportion from individual income taxes. The federal personal income tax accounts for almost 44% of the total federal revenues. All U.S. citizens, resident aliens, and most others are required to pay federal income tax. Rates that are paid for taxes on income rise depending upon income. This is a progressive system. So as your income rises, your rates also go up. If you were to look at where rates are at the end of 2007, what you would see is that here's our tax bracket, the bracket of income that is taxed. Here's the rate, and as the income increases, so the rates also increase. The top tax bracket is 35%. Under our administration's new tax policies and guidelines, that rate is going to go up significantly higher than 35%. Some other important taxes in the federal system. There are some interesting arguments for the progressive tax. In general, we have this sense that rich people, people who are wealthier, should pay a higher proportion of their income in taxes and help out those that are less fortunate. This is called redistribution of income, the idea that people who have more income should pay to those who have less. There's also the theory or an ideological principle that if you have the ability to pay, you should pay more. And then there's the other idea that wealthy people have clearly received benefits from living in a country that incentivizes people to make a lot of money. And therefore they should pay higher income in the way of taxes than those who are poorer, who have not benefited as much. The counter-argument is that there's no strong evidence that redistribution does anything positive in the economy, but that it's just a waste of money throwing it into the hands of those who are less able to pay. Let's talk about capital gains. This is a difficult concept to understand for those who have never invested money. But consider that you buy a share of General Electric stock and you pay $30 per share for that stock. You bought the stock in January. Now it's coming to the end of the year and you're going to fill out your taxes. And so what you're saying is, I've got this stock, I paid $30 a share for it, now I can sell it for $60. I'm doubling my money, so I've made $30 a share. The question is, what is your gain? Well, your capital gain is the difference between what you paid for the stock and what you sold the stock for. So the difference between $30 and $60. So your capital gain is $30. Well, the government taxes this gain. But the nice thing is, they tax it at a lower rate than they tax your income. So if your top income tax bracket is 35%, your capital gains tax is going to be close to 15%. And the reason why we do this is because we want to encourage people to invest. Because as people invest their money, it allows the economy to grow. And so the government says we're going to tax capital gains at a lower rate to encourage people to invest. Now what happens if you didn't make money? What happens if you bought the shares of General Electric at $30 and bad things happen? The market fell. And now at the end of the year, your stock is worth 15. So you bought it at 30, your stock is now at 15, and you're going to sell the stock and you're going to lose $15 a share. Well, the tax code allows you to recognize that loss and to match it against gains that you may have made in other investments so that you would pay less taxes. All of these things, these capital gains and capital losses in the tax system, are created in a manner as to encourage investment because the economy cannot grow without investment. The corporate income tax accounts for only 12% of federal tax revenues. 2% or less of state and local taxes are through the corporate income taxes. This is an interesting dilemma because we perceive that we would like to raise more money as a government and we would like to charge corporations a higher tax rate. But corporations are a little bit different than people. Individuals, we live in this country, we enjoy the freedoms that we have and we pay our taxes. Corporations can move. They can relocate. And so governments have to be very careful that they don't charge a tax rate that is so burdensome to corporations that they don't just say, we're out of here. We're going to go to another country. And indeed, that's what happens. Corporations do move. Halliburton has moved to the Middle East because their corporate tax rates are a fraction of what they are in the United States. So corporations can move fairly easily. The reality is the United States has one of the highest corporate income taxes in the world. And so a lot of our corporations, as they assess their options, think about that and say, well, we can move to another country that has a lower tax rate. Because if you have a lower tax rate, those profits, instead of going to the government, end up going into the shareholders' pockets, which most shareholders approve of. Corporate tax rates in general go from about 50% or $50,000, 15%, down to 35% at the top end. You need to realize that the average global corporate tax rate is about 18%. So the United States is well over double the average corporate income tax rate. Now let's talk a little bit about double taxation. This is an interesting concept. Remember we talked about investing in GE? Well, say we bought GE stock at $30. Well, every year, General Electric pays a dividend. And it pays you a dividend because you're the shareholder. But remember, we have corporate income taxes as well. And General Electric is in the United States. So General Electric pays taxes on its income at 35%. Then they pay dividends to their shareholders. And as soon as you get that dividend check, you have to pay 35% of that in personal income taxes. So this is a principle called double taxation, where corporations pay taxes on their profits, they declare a dividend and pay it to their investors, and then that dividend income is taxed as well. Retained earnings are something that is inside of a corporation. So before General Electric paid me a dividend, it made money. Say it made $100 million. Well, after it makes $100 million, it has a choice. It can keep that money inside the company and grow the company, or it can dividend or send that money out to its shareholders. The amount of money that it keeps inside the company for growth is called retained earnings. The amount of money that it sends out to shareholders as a dividend is called a dividend. Another concept called tax incidence. It's the distribution of tax burdens that people actually pay. Let's give a Hawaii example of this. You know, when you come and visit Hawaii, you probably come here on vacation as a family before you came here to school. You stay at a hotel. Now, on your hotel bill, at the bottom of the bill, it has a line called taxes. When you rented a car, at the bottom of the bill has a line for taxes. When you had your meals, at the bottom of the bill is a line for taxes. What's interesting, though, is those taxes were used by the government of Hawaii. And the people who paid those taxes, the visitors, the tourists, they don't live in Hawaii. They're never going to have any benefit from those taxes. So the tax incidence was borne by tourists, even though the tax benefit benefited those who live in Hawaii. So tax incidence is an important thing. In Hawaii, it's interesting because we can have our benefits paid for by people who don't live here and don't vote here. So the tax incidence is borne by the tourists. The tax benefits are yielded by those who live here. So tax incidence is distributed among consumers, stockholders. You pay your tax on dividends. You are the tax incidence. You bear that tax incidence. Employees pay Social Security taxes. So they bear the incidence of Social Security taxes. There's also Social Security taxes that are charged against your individual incomes. Each of you who work for the PCC, when you get your check, you see at the bottom of your check, it says Social Security taxes paid. It's about 8% of your income is paid in Social Security taxes. But your employer pays another 8%. So Social Security taxes are charged directly to your payroll on your check, taken out before you ever get your check. Unemployment taxes. These are paid by your employer. It's about 0.6% on the first $7,000 of wages you earn for employees that earn more than $1,500. States may levy additional taxes of up to 3% based upon the record of the employer. So if the employer is constantly firing people, that employer has to pay a higher rate on their unemployment rates. If the employer never fires people, in other words, people never have to get unemployment taxes or benefits, then they'll have a very low rate. Let's talk about a couple of other things and then we're done with this chapter. State and local governments, taxes imposed on goods and services yield more revenues than income taxes. What that means is when you go to Foodland and buy your food, you are charged a sales tax. That's called an ad valorem tax, which we're going to talk about in just a second. Ad valorem means at value. So your sales tax is charged based upon the value of the goods that you purchased during that session at the Foodland. A fundamental issue here is how to set tax rates to extract the largest possible payments. You know that some things in your sales tax are exempt. Some things are not. So the government has to constantly do an analysis of what it can charge or how it can charge rates to maximize the amount of tax revenues that they are able to generate. Sales taxes, as I mentioned, are assessed on the prices of goods and services that you may purchase. It's called an ad valorem tax, assessing taxes based upon the value of the goods that you're purchasing. Now, the way to analyze these taxes come in two categories. One is static tax analysis. And what we assume is, we assume that nothing changes. That if you lower the rate from 10 to 5%, then you will just collect that difference between 10 and 5% drop. Dynamic tax analysis is different though. It assumes that things change, that people change, that they behave differently. When my wife and I were younger and in school, my wife worked as a nursing coordinator at the local hospital. Her job was to make sure that the hospital was fully staffed with nurses. When they were short, she had a list of nurses that she could call. And she would give them a call and say, hey, would you like to work this shift? And they would give her an answer. And what was interesting is that so many of the nurses knew exactly where their tax bracket was and they would say, you know what, I can't work another shift because it will increase my income to the point that I'll be in a higher tax bracket, and I don't want to do that. So that's dynamic tax analysis. That's the analysis of, should we raise rates, and if we do raise rates, what behavioral changes does it make? What do people do differently? If the disincentive affects higher tax rates are small, static analysis may give a fairly accurate estimate of the change in tax revenues. However, as tax rates escalate, members of the public have a greater incentive to remove their activities from the tax base. In other words, to not work. So as rates go up, the public says, I'm not going to work if I give an increasing share of my income to the government. If you look at states around the United States, you can see that sales tax rates vary dramatically. States like Oregon have no sales tax. So a lot of people tend to go to Oregon to buy big ticket items like automobiles, washers, and dryers. Hawaii has a rate that's about 4%. Places like Alabama, 15%. So 15% of all the purchases that you make in Alabama are sent to the government. That's an enormous tax. So the government has to sit there and analyze. It has to say, what are we going to charge in terms of a rate in order to maximize our sales tax? And what they realize is that things aren't nearly as they expected. During Ronald Reagan's presidency, a guy named Art Laffer created what is called the Laffer curve. And this is an example of it here in this chart. And what it says is that here we have tax revenues, and you say, well, of course, as rates go up as a percentage, what happens to tax revenues? Well, they also go up. And we would expect that to happen. Because as I charge a higher percentage of sales tax, I'm going to have an increase in revenues. But what we didn't expect is that it peaks at some point, and then it starts to fall. So what this says is that after 6%, at 7%, my total revenues start to decline. And the reason why they start to decline is because we change our behavior. So during Ronald Reagan's presidency, they thought, you know what, we're out here. And if we want to maximize our tax revenues, we don't want to increase tax rates from this point. We want to decrease tax rates. So they said, what we're going to do is we're going to drop tax rates so that tax revenues actually increase. Now this seemed very counterintuitive. Didn't seem to make much sense. And indeed, the critics of Ronald Reagan argued that this is an absolutely insane policy and was considered to be voodoo economics. But he did it anyway, and he continued to drop tax rates, and indeed what happened? Tax revenues increased dramatically. So this idea and this theory called the Laffer curve took general prominence throughout the economic community. And so now there's legitimate argument with economists as to whether tax rates are too high and need to be reduced in order to increase our revenues, or are taxes really over here and tax rates need to be increased to increase tax revenues. There's some international examples. Iceland slashed its tax rate and boosted its tax revenues significantly. During the 1990s and 2000s, the Icelandic government gradually cut its corporate tax rate from an initial 45% to a current tax rate of 18%. What did it do? It caused businesses to move into the country, because businesses now gave up a fraction of what they were currently giving up in terms of profits to taxes. In the process, the government's inflation-adjusted revenues from corporate income taxes more than doubled. So as you drop your tax rates, tax revenues increase. A few other taxes to end out this chapter in our discussion. One is called the excise tax. It's a tax levied on the purchase of a particular good or service. Hopefully, you're not a liquor drinker or a cigarette purchaser, but if you were, when you buy a bottle of liquor, there's a little tab on the top of the cap. This is a tab that indicates that the excise tax for this liquor has been paid. On every package of cigarettes, there's also a little excise tax tab on the top of the package of cigarettes. That indicates that the excise tax has been paid. Also, a unit tax, which is a constant tax assessed for every unit of a particular good that a consumer purchases. That's the end of our tax chapter. Please review these slides over and over and prepare yourself for the assignments associated with this chapter. And we look forward to seeing you again in the next section.